Well, kia ora and welcome to episode 99 of Talking Dairy. You'll probably notice a bit of a different voice here. I'm Sarah Perriam-Lamp. I'm your guest host today. Thrilled to be joining you. They've thrown me behind the mic today as I'm also going to be live on stage soon as the MC of the 2025 Farmers Forum events. And this year's Farmer Forums is a chance to take stock and move forward with practical, science-based insights on the issues that matter most to dairy farmers. We're talking environmental policy, climate research, people challenges, innovations on farm, and of course the economy, which in every way, shape or form, both here at home and around the world, affects our dairy farmers. So today I'm very lucky to have two of the sharpest thinkers on economic commentary, Brad Olsen, Chief Executive and Principal Economist at Olsen and Cameron Bagrie, Managing Director and Chief Economist at Bagrie Economics, on this episode. And I'm very, very excited to have a good old yarn to these two, particularly around some of the topics that we'll be zooming into on their session when both Brad and Cameron speak at the different farmer forums that are happening around the country. So let's get into it. Brad, I know that you are joining us today from South Korea, and that is a market that we are focused very interestingly on in the New Zealand economy in terms of opportunity. Let's just start in terms of dairy's opportunity for Korea. What are you seeing there?
Yeah, I mean, it does look like there's quite a bit of opportunity. I mean, South Korea is New Zealand's fifth biggest market in terms of country exports that we send out. Dairy is our third biggest export over here. The only bigger ones are the likes of travel and also aluminium, because we send over some of the good stuff so they can make all the cars that we eventually import back through. So, look, there is a lot already happening. I think there's still a lot of opportunity going forward. We know that there are trade ructions going on across the world, but people are still looking for good quality products. They're looking for clients that they can work with and that are sort of trusted partners. For New Zealand, we're in a pretty good space, I think, on that front. We have a very compelling push that we put into different markets. They know that they can trust the products they're getting. They know that they get quite a variety as well from New Zealand when it comes to sort of dairy. It's not just milk powder, but it's sort of everything throughout the entire value chain. So a lot going on there. I'm quite interested at the moment in the changing consumer preferences, though, that we're seeing. Around the world, there's still quite a focus on convenience, people looking at how they can order stuff into their own areas. And again, just sort of how different cooking and changing dynamics, particularly through Southeast Asia, are coming through. I remember, for example, about 2 years back, I was in China having a look at some of their consumer trends. A couple of years had passed since I'd last been there, still our largest export partner. They were all of a sudden eating quite a lot of pizza. And for New Zealand, we were supplying, I think, half of all of the mozzarella cheese that was going onto those pizzas. So, quite a lot of evolution there in the sort of products that are coming through, but definitely some big overseas opportunities. But let's be clear, everyone's a lot more cautious at the moment too. So some good and some bad sides, I think, on the trade front.
It's interesting, Cameron, the focus is very heavily on our trading partners in Southeast Asia as the reliance we don't want on the States with what's going on. And we definitely are going to get into what's happening in the States. But China, what worries do we have there, but also what opportunities at the moment?
China is still the second biggest economy around the globe. You need to be there. If you look at the numbers, what are exports from New Zealand into China? About 19 odd billion of goods. Number two is the United States, a bit in excess of 9 billion. Australia is a bit in excess of around 9 billion as well. And so China is strategically more important than number 2 and 3 combined. But what we know at the moment is that there's a bit of a bun fight that's going on between what we call sort of the Alibaba world and the Amazon world, and that's China and the United States. And we've been used to an environment for 30 years where the commercial or economics of trade has dominated. Trade barriers were coming down. New Zealand's chief trade negotiator refers to the old golden era, Vangelis Vitaris. Well, Vangelis is now talking about the end of the golden era because protectionism is rife. You are starting to see what's called geostrategic, geopolitical considerations are starting to dominate the commercial, the economic imperatives. And that's a 1950s, 1960s, 1970s world. It's not a world that we've been used to for the past sort of 30 to 40 years. So New Zealand's going to need to pivot. We're going to need to change. And we're watching, I guess, with a little bit of patience in regard to what's going on around the globe. because protectionism is here and we like less protectionism, not more. Unfortunately, the trend's going the other way.
Do you know what's interesting, Cameron, is those non-tariff trade barriers such as that protectionism are using. We've got commentary in some pockets of the dairy industry that may say, oh, that's just a European thing to keep us out. It's a US thing. But China will take our milk no matter what. What are you seeing protectionism in that part of the world for dairy?
There's very few countries around the globe where you see zero barriers. There's an awful lot of protectionism of, industries, whether they be infant industries or subsidies to try to drive market share, that sort of stuff. And the bigger picture here is still very simple. I'm just not quite sure the penny has dropped yet as to how much of a strategic shift we're now seeing away from commercial reality to geopolitical reality. And geopolitics is a lot more about security. I guess if you sort of think about where do you need to be secure in? You need to be secure in the supply of food, which probably plays into New Zealand's strength. Supply of energy, we've got a problem there in regard to our reliance. And the third one is technology. For economic advancement, you got to make sure that you got access to the latest technology. And there is a bun fight going on at the moment between the United States and China, and it's involving the Netherlands, it's involving Japan in regard to access to the latest technology, particularly over the old microchips, the semiconductors, because the chips control the computers and the computers control the machines.
Yes, and this bun fight, Brad, is having all sorts of up the wazoos with regards to the US dollar versus New Zealand dollar, what impact it's going to have on our inflation, what the reserve banks are going to do, et cetera, et cetera. But focusing on the US, I read somewhere around a 61% chance the markets have baked into a recession in the US. How likely is that?
The chance of a US recession is certainly rising. I think probably importantly, even if they don't enter a formal recession, their economy is going to slow back markedly over the next 12 months and probably longer than that, particularly if you do see those tariffs remain. Even if the tariffs get removed, though, no one's going back and immediately trusting the US like they did before the tariffs came through. Everyone is quite rightly now going, look, there is greater instability across the world. I'm not so sure that I can trust that, we'll sign up to an agreement and it will continue to go through. I mean, Trump signed up to agreements with Mexico and Canada and then immediately sort of went back on them quite quickly. So there is a real level of, I think, worry there. And the other part, particularly for the US, is all of these tariffs are paid for by US consumers at the end of the day. And that means that, long story short, the US is going to have higher inflation. Now, that has implications for interest rates. It has implications for the exchange rate. It has huge implications for how much are US consumers going to be willing and able to buy. More of their money is going to pay for a tariff. That's less money they've got available to buy all the other stuff that we're hopefully sending them. And so it is sort of, very specifically in the first instance going to hit the US economy. But given that the US is the world's largest economy, given the financial implications and how the rest of the market works globally, how the US goes in terms of its economy over the next 12 to 24 months, the next 1 to 2 years, will have much bigger sort of flow-on effects. But it's also, I think, almost wider than that, where we're talking a lot about sort of the two biggest trading partners that New Zealand has in China and the US. But you look sort of down through the ranks and it starts to become a little bit more apparent that, there is this sort of question of, well, where do we go in the next era? We look at other countries and we say, look, we should all be trading sort of in a free and frank and very easy liberal sort of society. We've still got ongoing issues with Canada and what they take on the dairy front at the moment, and for as much as they're saying, well, we need to play by the rules and the US needs to play by the rules, I mean, they also sort of need to put up or shut up. You look then at the likes of Europe, again, big market for New Zealand, but equally, some of the regulatory barriers and similar to get in there are not easy. And so I think that there's both been a speeding up of the sort of trade challenge that's emerged with the tariffs. But even before then, it was finding, or you were sensing that it was becoming harder and harder to find this sort of big, huge new trade opportunity. It wasn't quite as easy as it was probably the last 10, 15, 20 years to find that next bit of trade growth.
Liberation Day was obviously the big bazooka day, but the seeds on where we are now have been sown over the past 5 to 6 years. If you go back to 2023, the Ministry of Foreign Affairs released their strategic document on where they thought the world was going, their trade-wise, and they identified 3 big themes. Theme number 1 was that the rules-based system that we've been used to, you could basically throw it out the door because countries are now exercising power. Now, good luck going to the World Trade Organization with a complaint.
But isn't China going to the World Trade Organization about the US?
Yeah, but it's just got no teeth.
Well, it's convenient, right?
Yeah, but rules-based system, now it's a power-based system. Security was having a lot more influence in trade in regard to dictating the nature of what you can trade, where you can trade, who you can trade with, etc. And then just in time was becoming just in case. Your onshoring was replacing offshoring, and that's symptomatic of security concerns as well. And once again, this just reinforces we are now in a world that's dominated by the geopolitical and the geostrategic, as opposed to the economics and the commercial imperative environment we've been used to.
What fear do you think, Cameron, we should have with high milk prices of any stockpiling behaviour?
What's the space? I've been surprised that prices have held up. It's an essential item. You need to put food on the table. But you look at oil prices, you look at copper prices, you look at all the other barometers of sort of global growth, and those commodity prices have headed south. Lumber prices as well. But New Zealand's commodity basket, and it's only a couple of weeks, has actually held up pretty well. But of course, where we've had the wall or where things have sort of slipped away has been in New Zealand dollar. And we've gone from sort of 56 and a half cents in the start of April to 60 cents. So you sort of lost 7 to 8% of your farm gate return in the space of 2 to 3 weeks. And look no further than Donald Trump, because his policy prescription is undermining the investability of US dollar assets.
But equally, Cameron, you look at how wild the swing in the dollar has been, though. I mean, in October last year, it was, comfortably sitting above 60 cents. It's continued to come down. It got sort of into that, low 55s. And in the space of like 3 weeks, it's gone back up to 60. Like, that's a pretty big shift in just a couple of weeks. I mean, you wouldn't have expected something like that. You could maybe expect the direction, but sort of the time and the magnitude and the risk that it goes back the other way, that you lose a cent or two every couple of weeks and then you gain it back. Like, the instability that creates, I think, is quite a big challenge. But equally, I mean, you look at sort of the supply and demand across the world, and I think that's probably going to be a slightly more important driver in the dairy space for New Zealand, at least sort of in the short term. The likes of milk production coming out, particularly from the Americas, both the US itself, but also, most importantly, some of those South American countries, your Uruguays and the like, Argentina, that's been pretty low in recent times. So we do seem to be putting able to put a bit more product into the market at a time when there's not quite as much coming through globally. But equally, if you do see those consumer shifts come around, if you continue to see all that dollar create a bit of havoc, but equally, if you see domestic production activity start to be hampered, and that's more likely in the North Island, as you see, that the likes of drought conditions have been declared across a number of areas. You've got a lot of drier activity. I was looking at some of the import data the other day. For the first couple of months of 2025, New Zealand imported something like 70+% more palm kernel than we did the year before. So, there's obviously a bit more pressure that starts to come into the system. So better starting point for now, and that's a great place to be when we're sort of facing tougher times. But I do think that sort of, Cameron's highlighting there's a real risk there going forward that things might not stay quite as rosy for quite as long as everyone might hope and expect.
If we think about this pretty basically, the world is now going to be a lot more uncertain, a lot more volatile. When you've got greater volatility, you've got greater uncertainty, investors are naturally going to demand a little bit more what's called compensation for risk. What does that mean? Your term premium, your longer term interest rates are going to be a little bit higher than what we previously thought. You're going to take in an additional equity risk premium within any valuation within the equity market. What does that mean? Valuations are lower. There's no free lunch here, and what we're seeing at the moment is a bit of bobbing around where markets are down, markets are up, but markets are just, I think, realigning to the new world order, which is a structural shift. And then we've got to think about, are we going to see a recession or not? The IMF came out overnight and said, it ain't going to be too flash, but it ain't going to be a recession. And we can debate that sort of stuff, but it's a new world order that we need to get our heads around. And in some ways, New Zealand's in a pretty good place because of what we supply. If you look at the real battleground here, it's manufacturing. There is a bun fight going on between China and the United States. And if China is not pitching as many goods manufacturing-wise into the United States, they're going to need to find alternative markets for those goods. And odds are they're going into Europe. So watch this space, because I don't think the European manufacturers or Germany or that sort of stuff is going to be that happy if they start to see a whole lot of repitched China products end up on their doorstep, because that's going to threaten their manufacturing sector. So, what we're seeing between China and the United States could be a bit of the appetizer in regard to what could be going with ripple effects around the globe. But it's manufacturing where the real battle is here.
Brett, what do you make about the decarbonisation of our shipping lines and how much that's going to affect our supply chain realignment?
Oh, it's quite a big shift. I mean, New Zealand, I think, abstained from some of the more recent work on some of that decarbonising the shipping activity. From an economist point of view, you want to make sure that whatever you're doing and whatever action it is sort of captures the full costs. And it's probably been clear for a while that we haven't fully been doing that. You're now seeing a greater regard for that overseas. And so, that all goes in, I think, into people thinking, and this is more from sort of the distributors that we sell to overseas, they're thinking a lot more about their own sort of carbon emissions, everything all the way up to those Scope 3 emissions come through. And I think that's also why for New Zealand it's important to sort of recognise how that part of the supply chain works. And I found this quite interesting myself a couple of years back, going over to Europe, talking to various sort of distributors and suppliers and similar. In New Zealand, we don't sell to the end consumer. We don't sell to someone who's shopping in Belgium or Germany or the UK. We sell to the people who stock the shelves in the supermarkets. And that's sort of the middle player there that we need to get our heads a bit more around. You go and talk to the Nestle's and similar of the world, and they're a lot more focused on that. There's a lot of regulation and costs that's already been put on them. So it's not so much trying to convince or figure out if the consumer's there for the decarbonisation that's happening. It's around who are the people we're selling to, how those distributors, what are they doing? Because if they shift, if they adjust, and this was the very firm view that I was getting talking to some over in Europe, they were like, well, look, at some point, if you can't help us on that journey, then we're probably not going to buy quite as much, because there won't be quite as much of a premium for your products. That's a pretty big sort of, not a threat, but just a reality in this day and age when there's a much greater level of focus on decarbonisation efforts. But I think, and this also goes back to Cameron's point, though, around, how the supply chain is changing. Things are being disrupted. Products are taking different paths to go to market, how they have to be staged, how much people are buying to make sure they don't run out, when there's another attack on some different shipping line or shipping route around the world. All of that, I think we haven't actually seen the full implications roll through, because there are still big changes to come. And for New Zealand, small little island nation at the bottom of the South Pacific, all of our stuff has to take a fair amount of time and cost to get somewhere. That does have sort of bigger ramifications. So again, I think it's a bit more of a watch this space, because there will be further evolutions of those costs, of how those supply chains work and everything else.
Cameron, interestingly, I've got my own sort of thoughts on the freeing up of the balance sheet of Fonterra with this mainland group and the selling of assets. Do you believe there's a lot more to come that dairy farmers aren't aware of cost-wise on the co-op that they're preparing for? So in terms of what impacts cost-wise are going to come at Fonterra and their suppliers that they need to free up capital for selling of those assets, what sort of things do you think they need to prepare for?
Well, I think what Fonterra is going through at the moment is just what every good business should do continuously, and that's assess the status of your balance sheet. Do you have a good quality of asset portfolios that's giving a required rate of return to your shareholders or not? Fonterra has been a bit of a rock star, to be fair, in the past sort of few years in regard to what's going on. Now, so it's a hat tip to Miles and Peter, the chairman of the board there. And obviously they've got a pretty big decision to make going forward in regard to whether they flog off a pretty big asset. What someone's going to be prepared to pay for on the other side versus what Fonterra could potentially add value themselves by retaining that asset. My instincts are, I think ultimately those assets are going to be a better fit with someone internationally. The issue then becomes, what does Fonterra do with the money? Do you reinvest? Do you return it to shareholders? And I know there'll be some pretty big calls from the shareholders to just give us the cash, but I sit around a number of boards and I don't like to tend to give money back, because it's like an acceptance of failure as a director, do you can't add value on behalf of your shareholders?
Brad, what's your thoughts?
Yeah, I mean, look, having the briefest of sort of overview looks at the financials, I can understand the conversation going on. I mean, the return on capital that's coming through from the consumer side of the business doesn't look as strong as what you're getting in other areas. So from, just looking at the finances, I can understand that. I think Cameron brings up an interesting point around what you sort of do with the capital out the other side. And I think one of the slightly different reasons that I think that there is much more merit this time than genuinely in others around a potential sort of return of that capital is it means that those farmers who do really believe in the activity in that sort of consumer side can then buy back into it or sort of, basically retain their capital into it to a point, and others have it a bit more released. But I think in terms of going forward, I've been really interested in the sort of forward profile that Fonterra set out around some of its big capital investments into some of its sites around the country. I think last year you had 3 or 4 big investment decisions come out over the next sort of 5 years, a lot more technology coming in across a few sites, sort of making sure that things are in the right position and sort of managing those assets over time, because these manufacturing units across the country, they're big, they're expensive, and they have to sort of continually evolve, both depending on where the milk's coming from and the product mix that is being demanded out across the world, but also again, sort of as our own domestic supply chains in New Zealand adjust. I mean, we're still waiting for ferry replacements. We're still having to move stuff up and down the country. We know there's a lot more, or seems to be sort of more economic growth happening in the South Island than the North Island at the moment, which is a bit of a reversal from normal trends. So a lot of moving parts there, but I thought it was also a bit of a confidence boost, an injection of confidence levied into some of the rural provincial parts of New Zealand where after a long time of it has felt like a bit of a struggle, I think, in the primary sector and manufacturing, that, there was some pretty serious dollars being talked about going back into some of those sites around the country in those rural centres. That's jobs and opportunities, not only directly but indirectly in servicing some of those sites. So again, a lot of water to go under the bridge, a lot of changes that sort of keep coming up, a lot of external shocks that keep coming through. But, on that sort of internal front, there still seems to be sort of a pretty good plan of where things go in the future. And that's encouraging, because if I was anyone else, you'd sort of look at, the instability we're seeing around the world, almost just throw your hands up and go, oh, it's all too hard. It's nice to see some of those big core strategic businesses for New Zealand having a bit of an idea and an eye to the future.
Cameron, we don't want the Reserve Bank to throw its hands up and say it's all too hard at the moment. What's your state of play for the next quarter or two?
Be careful what you wish for. The way economics works is that bad news can be good news. The good news that we tend to like is interest rates coming down. Well, interest rates tend to come down because of bad news precedes it in the form of, the state of your economy. Because the worse off the economy, the more the Reserve Bank's going to have inflation under control, or the worse the global environment gets, the more deflationary that could be, through commodity prices, that sort of stuff. And that's where you need to reach for the party pills and you cut interest rates. We like the concept of low interest rates, but it tends to be associated with bad economic outcomes, particularly if you see the official cash rate drop below 3.5%. So your 3 to 3.5% OCRs, where the Reserve Bank's, in my view, neither got the foot on the accelerator or the brake. Now, you think of the Reserve Bank having a nice little holiday in Thailand. They're not doing too much. They're having a nice little siesta. And I see ANZ came out the other day that the OCR might need to go to 2.5%. That's because we lost a bit of growth through some of our key economic engines globally. And that's when you need the replacement coming through interest rates to sort of buoy up the property market. Now, the problem I have with that, and I'm a little bit worried about this rise of the New Zealand dollar, ultimately for the next sort of couple of years, to reach what's called the Holy Grail, we need a lot more balanced growth. We need a lot more growth coming out of the export community. And that requires a lower New Zealand dollar, around 55 to 60 cents. It needs a policy prescription that's export supportive, and it needs a global environment that's friendly. One of those boxes we can tick. We're looking on a bit of frail ground in regard to the others. Exports have gone from 28, 29% of GDP to 24%. The current account's still in excess of 6% of GDP. We don't want to borrow and spend economic recovery because it's just not going to be a quality recovery.
Do you think the banks haven't got an invested interest in the agricultural sector enough with their books to actually want to see the economy rise through export rather than property growth?
Let's have a look at just some real economic basics, right? Way back in 2000, housing was about 50% of total bank lending. It's now 63%, right? So bank lending has been increasingly skewed towards the low-risk asset, which has been the housing market, and that's been accelerated in the past few years when the Reserve Bank has told the banks to hold more capital. So hold more capital, you might not need to put in more capital, but you shift your asset allocation away from lending into the business and the agri sector into the housing market because you need to hold less capital against it. Now, it's pretty simple economics. If you look at the productivity across the primary sector in New Zealand, the primary sector averages around 2% productivity growth every year. Now, if we're redeploying resources from the export sector, from the agriculture sector, which is shrinking as a share of GDP, into the housing market, which is what we've done, in the housing market, the productivity coming out of that sector is zero, then by definition, you do the maths, productivity is going to take a hit. I have a few concerns about what's going on here, and you can't just point the finger at the banks. Right, the regulator, the Reserve Bank has been in the middle of this with, getting the banks to hold more capital, which has been a massive own goal. Banks have just reallocated, shifted their balance sheets. But the finger also needs to be pointed at the banks in regard to their behaviour. Their returns are incredibly high. Like if you look at the last 12 months, banks made $10 billion. And people are telling me this is hardest economic climate since the GFC. I'm sorry, well, the banking sector, if you look at their impaired asset expense, 0.08% of their assets were impaired. It's a drop in the bucket compared to the $570 billion worth of loans that they make. So it sort of begs the question, banks are pricing for risk, but are they actually taking risk? And if you want to drive a productive, innovative, thoughtful economy, you've got to get that balance between taking and pricing risk. And at the moment, New Zealand seems to be priced for risk, but banks are not actually taking a lot. So I think it's actually holding us back, and we need to have this sort of conversation around the role of the regulator, the banks, the government, but also businesses. Businesses, to be fair, need to lift their game in regard to what's called bankable. I've got another business called Chaperone, helping business navigate banking, and we see a lot of instances where the problem is not the banks, the problem is quite often the business.
That's a whole nother topic for a whole nother episode, and I'd love to dive into more of that. But interestingly, Nicola Willis is starting to be called out for putting her fingers under the hood a little bit too much, Brad, but it seems like from what Cameron's saying, someone needs to be able to stimulate the productivity of the economy.
Oh, I do think that we sort of need to have that conversation. I mean, you're right that some of these concerns start to come up when we talk about, the right level of bank capital holdings and similar, that the government starting to hit the Reserve Bank's independence. I personally think that's a little bit overblown. The Reserve Bank has absolute operational independence when it comes to monetary policy, interest rate settings and similar. Like if Nicola Willis or Christopher Luxon or anyone else came out and said, I think that the Reserve Bank should cut interest rates, raise interest rates, whatever, that sort of thing. That's way beyond the pale. I think the government of the day coming and saying, look, we're trying to grow the economy and we keep hearing from people that they can't get loans for stuff and therefore they can't grow their businesses because the Reserve Bank and the banks in various forms, the regulations are set up in such a way to skew the money here rather than here. I think that's a valid conversation to have. You're not having the government coming in and saying, hey, Reserve Bank, by the way, I'm just ripping up your bit of paper and telling you what the bank capital requirements are. They're saying, hey, we've got some real concerns about how the economy is running and what effect this has. Can you go back and check your homework, please, and make sure that you were actually as confident as you were a couple of years back, when everyone seemed to be sort of harbouring some sort of concerns that do seem to be playing out. But I think also, and this is where the point around what businesses need to do, I worry a little bit that even if we got the right settings in the right places, are we sort of a bit too risk averse now? And I sort of get that after the uncertainty of the last couple of years. Like it was pretty tough. No one sort of knew what day was going to bring what new sort of announcement, be it COVID, be it inflation, be it certainly at the moment with trade and tariffs. But from a risk point of view, it does seem like for the last 5 years or so, it's sort of easiest move has been to make no move, to take no risk, to sort of just sit on your hands. And I think that we need to sort of get back to the position where everyone in business needs to be just a little bit freaked out that if they don't move, then someone's going to come up and eat their lunch for them. And that we need to get back to that area where you are not in a bad way, but taking enough risk to sort of move things forward to sort of see how they move. In the primary sector, I think that's always it becomes a little bit more of a challenge. Like one of the reasons, right, that if you compare lending to someone in the agricultural sector to a house, is that you know that, look, at some point there's going to be something that hits, part of the primary sector. There's going to be a drought, there's going to be a flood, there's going to be some sort of health emergency or something that comes through. So you know there's going to be a bit more ups and downs. So yes, it has a high risk profile. Is it completely black and white, though, that, farming and the primary sector is like completely unborrowable against because of that, and that the housing sector is just, oh my gosh, gold plated? No. And I think that's where we've sort of got out of step, is that those two poles seem to have been driven apart a lot more. And so you're not seeing as much funding going into the primary sector. I also feel like people are not necessarily as willing to make that commitment. And I'm genuinely not sure what we do about it. Even if you had a bunch of banks and the Reserve Bank and everyone else that got every business sort of, borrow ready and they could go and get that funding, are businesses going to sort of take that jump? If I'm sitting on a board today and someone says, look, you need to buy this new equipment, it's going to take 5 years to pay off, and you know that in one of those 5 years, you're probably going to have a bad year because something's going to happen. Would I do that? Or would I sign off on, hey, we'll just use a temporary workforce that we can scale up and down every year? It doesn't lead me to a good long-term position, but it's pretty easy to justify on the short-term basis. So I think we've got to somehow get everyone back into that little bit more of a shockable zone where they know that they need to take a bit of risk, not in a bad way, but just enough so that the wheels on the economy keep turning.
We need to have a serious national conversation about whether we've de-risked New Zealand too much. We suffer from road conitis. It's just, the health and safety. A young kid climbs a tree, falls out of a tree. What are we going to do? We're going to chop down the tree. It's just gone absolutely nuts in regard to, little wonder that we don't have the appetite to get out there and have a bit of a crack at things. We can point the finger at the regulatory policy settings, we can point the finger at banks, but I think there's also a story here about the culture that we've now brought into New Zealand, that we're very risk averse. I see it through listed companies, right? We always want to give people back the dividends. Whereas you look at an American company, the American company's going to keep the money and they're going to invest for value, they're going to invest for growth. They're going to back themselves to make shareholders better off. In New Zealand, we've got a sort of a track record of blowing capital.
Interesting. If we're looking at the forecast of the next season for a dairy farmer and you're looking at all those key indicators, Cameron, you've got opportunities to hedge in certain parts of your business and float or go along with schedules on others on both income, so milk price hedging, and on cost on inputs with a US dollar fluctuation, inflation, OCR, everything going on all over the show. What parts do you try and control and what parts do you ride out?
A lot of this comes back to your risk tolerance or your balance sheet. I also tend to apply what's called the sleep test. If it's keeping you up at night, do something about it. There's a basic sort of philosophy to run. If you've got a strong balance sheet, be prepared to take a little bit more volatility within the income and expenses because you got the ability to ride it out. If you've got a weak balance sheet or you've got a lot of leverage, you want to have certainty so you know that you're going to be around a season or two down the track. You take the certainty, you pay the premium that comes in with locking in forward points, whether that be the currency or interest rates. You pay the term premium by taking in longer term interest rates. But a lot of it comes back to preference, but your good old economic basics in regard to the state of your balance sheet. Now, stepping aside from that, given where the numbers are at the moment, and given the risk profile that I see around the globe, I'll be taking the bird in the hand.
Yeah, look, I mean, fairly similarly. I mean, given where the prices are at the moment and sort of where the early parts of the schedule look like they're going to sort of come out, everyone, I think, has gone through a bit of a tough hit the last couple of years in some way, shape or form. And so I feel like, one of the first things I hear from a lot of people, and I thoroughly endorse, is you want to take back a little bit of that debt that you've probably had to accumulate. You want to try and get things down a little bit more sustainably. Sometimes that'll have to be a bigger shifts, sometimes it's a bit just what sort of manage it as it goes. But I think particularly on the cost front, between 2020 and the end of 2024, there was something like a 25 to 30% increase in input costs on farm. And so from that point of view, I know that talking to a lot of people in the sector, there has been a real level of, hey, we might need to defer some of this. We're not going to do as much fencing. We're going to lower our fertilizer use and similar, knowing full well that's going to have some implications for the years ahead. But also, I just couldn't justify it so much at the time. Now you're starting to see some of those figures pull back a bit. The likes of your fertiliser costs are down a bit. Your fuel costs are lower. Your finance costs are lower. And so I think for a bit, there's sort of a staging. Firstly, I think people are going to deleverage themselves a bit, and that's super appropriate so that they've got a bit more wriggle room and it will be when the next sort of big hit comes through. Then I think there will be a little bit of that catch-up that comes through and people probably hoping that those costs will be a bit lower. I think that's broadly on the money, but I think there's also probably a bit of caution. We've talked a bit about supply chain issues and similar. Maybe there's still a few ructions there. But I do think it's a little bit of everyone's going to go back to basics a little bit more. Everyone is still a little bit more uncertain. And so that's probably the phasing. It's the debt first, it's the cost second, and then it's the expansion. It's the next big thing. It's the next sort of wherever things go in the future. That will take a little bit more time.
So, Cameron, we've got so much more to talk about on the road at the Farmers Forum this year and the events coming up. But just your last closing thoughts for dairy farmers. We've talked a lot in the last 45 minutes, just to have that one thing top of mind to keep your close eye on, particularly globally.
The world has changed. We've been used to 30 years of economics and commercial imperatives being in the driving seat. We're now in a world where the geostrategic and the geopolitical is front and centre. And that is going to mean a lot more volatility. So plan around it.
Brad, your parting words.
Oh, look, there's a lot of moving parts out there at the moment. I think there's a fascination with trying to keep up to speed with all of that. And I think that's important to a degree. So, yes, totally keep an eye on the news feed, but don't let that sort of become doom scrolling. Because at the end of the day, we can't do a lot about that. We can keep an eye on it. But I think probably the biggest message is when you sort of are faced with a lot of these big uncertainties that are continuing to hit, and you can't necessarily influence them directly yourself, in your business, in your farm, wherever you are. Look at the stuff you can control and sort of focus on that, because those are the levers that are in your power. It's one of those things that is going to be, I think, a tougher, more uncertain environment. But if you're feeling more in control of stuff that you do have the power over, that sort of sets you up better to respond to the stuff that is outside of your control and will make you fret, but you can't do anything about. So sort of just control the controllables for the moment.
Absolutely wonderful advice. Thank you so much to Brad Olsen and Cameron Bagrie for sharing your insights. And no doubt the global economy may feel so far away from the farm gate, but all smart progressive dairy farmers keep a very close eye on them and how it unfolds here at home. If you're keen to hear more, plus a stacked lineup of practical speakers, experts and farmer panels, come along to one of the 3 Farmer Forum events. You'll find the details on the DairyNZ website, as well as probably in the podcast description below. First one's in Hamilton on the 27th of May, followed by Ashburton the 17th of June, and Invercargill on the 2nd of July. I look forward to seeing you there as your MC. You have been listening to the Talking Dairy podcast. I'm your host, Sarah Lamp, as a special host on this particular episode. So thanks for tuning in. Make sure to hit follow so you can keep up to date with the latest Talking Dairy podcasts, and head to DairyNZ on Facebook, Instagram, LinkedIn, the website, and of course the newsletters that come through. If you want to email the podcast, talkingdairy@dairynz.co.nz.